Let's begin with a simple observation. Risk used to be allowed to clear. It no longer is. Not because markets changed their nature, but because the system surrounding them changed its tolerance. What we call risk today is not something policymakers allow to resolve. It's something they manage, something they suppress, delay, and redistribute. That distinction matters more than most people are aware of and realize. What natural resolution actually used to mean? Historically, risk resolved through price discovery. If leverage built too far, prices fell. If capital was misallocated, losses forced for the adjustment. If speculation ran ahead of cash flow, it corrected. This wasn't moral, it was purely mechanical. And markets cleared because they had to. Volatility was not a policy failure, it was the mechanism. Pre-1987, risk was real. Before the late 1980s, market participants understood something implicitly. And that was, you could be wrong and you could stay wrong. You could be taken to the cleaners, not zombified. There was no guaranteed rescue. If you were over-levered, the market did not wait for you. If you mismatched the duration, you absorbed that loss. If you sold the vol at the wrong moment, you paid the price. Risk resolved through liquidation. And liquidation, while painful, it was fast at least. 1987, that's when the first constraint appeared. It's like the 0 day. October 1987 did not just produce a crash, it produced a precedent. The Federal Reserve intervened immediately, not to cause the economy to prevent it from overheating, not because the economy collapsed, but because the markets did. And that moment quietly redefined the boundary. Market functioning itself became a policy objective. Risk was no longer something to be allowed to fully clear if its resolution threatened systemic confidence. But this was not yet suppression, but it was definitely containment. If we fast forward 1998, LTCM, long-term capital management, and the end of pure liquidation. Now, long-term capital management should have failed cleanly. It didn't. The positions were theoretically sound. Some of the most brilliant physicists and mathematicians thought up these strategies that seemed infallible, but they were structurally fragile. Mixing excess leverage, correlation breakdowns, convexity misjudged, duration mismatched. The concern was not LTCM's losses, it was who those losses would hit next. It was the contagion. And the response? The response was coordination. Risk did not resolve naturally in that scenario. It was absorbed and it was redistributed. That mattered. 2008, fast forward again. Natural resolution became utterly unpalatable and unacceptable. By 2008, the idea of letting risk fully clear was politically and economically untenable. Leverage was everywhere. Banks, insurers, structured products, sovereigns. Allowing full liquidation would have meant systemic collapse. So the response was not resolution, it was suspended animation. Markets were frozen, balance sheets were backstopped, losses were socialized and distributed. From this point on, risk was no longer allowed to resolve freely. That was the change. But what changed structurally? The problem was not markets. It was the embedded, layered, synthetic, systematic leverage. Duration risk buried inside institutions that could not mark losses in real time. Does that sound familiar? Private credit, anyone? Volatility exposure sold systematically through options and structured products. Again, does that sound familiar? Funding mismatches that only worked in perfect equilibrium test tubes in vitro conditions. Now, in that environment, volatility itself became the danger. Not because it was irrational, but because it revealed fragility. The new rule, volatility is the enemy. In the modern system that we live in right now, volatility is no longer information. It's a threat vector that must be neutralized. It forces high volatility, which begets more volatility, forces margin calls, triggers VAR constraints, shrinks dealer balance sheets, accelerates deleveraging, and left alone, it becomes what most people fear in the markets. It becomes non-linear. So policy duly reacts early, not to save investors, but to prevent reflexive collapse. So from a trader's perspective, why do shorts now feel like a broken mechanism, an antiquated atavistic tool? Because from a trading perspective, this explains a familiar frustration. Shorts don't work the way they used to work, not because fundamentals are irrelevant, but because downside convexity is capped. The moment price action threatens forced selling, liquidity appears, volatility is suppressed, positioning is relieved, risk is interrupted mid-process. The trade is not wrong, it is cut short by the immediate intervention, or at least the forward pricing and the reaction mechanisms that position algos and arbitrators for the inevitable stimulative reaction and intervention. The VIX isn't a fear gauge anymore. Historically, rising vol signaled risk. Today, it signals policy proximity. A rising VIX no longer means something is about to break. It often means something is about to be intervened with and stabilized. And that inversion, that perversion of an inversion really matters. And that's why corrections feel so shallow. Corrections no longer cleanse positioning naturally. They relieve it. Dealers reduce exposure, CTAs flip, vol control funds adjusts, then liquidity steps in full force. Risk does not complete its cycle as it would naturally in a normally functioning ecosystem. It's just paused and delayed. And this is why markets feel permanently unfinished. The cost of suppressed resolution is very real. There's a price to that regime. There's a price to keep the carry ticking over on that regime. And there's a huge theta burn to pay for it. Risk does not resolve and it does not disappear. It just accumulates. It's like energy transformed. Leverage remains, mispricing persists, duration exposure grows. Each cycle requires a few things: faster responses, higher responses in terms of magnitude, larger balance sheets, lower tolerance for movements and wider spreads. That's not stability, it's dynamic maintenance. There's a historical parallel for this as well. It's not just modern. Post-war financial repression comes to mind because after World War II, risk was not allowed to clear either. Debt levels were way too high. Adjustment was managed through yield caps, capital controls, negative real rates. It wasn't the first time in the modern era. Volatility was suppressed deliberately. Markets existed, but within constraints, highly regulated constraints. And paradoxically, we are closer to that regime now than we ever care to admit in a post-war, not even in a world where there's war anymore, in an antebellum scenario, pre-war. This feels unnatural to us, especially to traders. Traders expect feedback mechanisms. They expect pain to teach lessons. But the system no longer allows that feedback loop to complete. Risk is not punished quickly. It's just rolled forward. That is why being right can often feel unprofitable. When risk is allowed to resolve, something else happens, something really perverse. There can be exceptions to this rule, because when the problem becomes solvency, not liquidity, it's a different ballgame. Liquidity problems are containable, but solvency problems are definitely not. When balance sheets cannot be stabilized without destroying currency confidence, risk resolves, but violently. And until then, it is managed. What does that mean practically for you and me and for the traders in the world? Well, it means volatility is suppressed until it isn't. Tail risk is underpriced until it isn't. Breaks come late and they come fast. The mistake is expecting gradual resolution. The system no longer permits gradual resolution. Risk hasn't disappeared. It's just been institutionalized. It sits inside balance sheets, inside policy constraints, inside suppressed volatility. And as long as that remains true, risk will not be allowed to resolve naturally. It can't be. It's just going to be delayed. It's going to be redirected. It's going to be contained. It's going to be constrained. It's going to be titrated until it can't. Now, markets haven't become irrational. They've become constrained and addicted. Risk is no longer resolved by just the price alone. It's resolved, when necessary, by policy. And that changes how every single trade should behave. Not because the market is broken, but because it's being held together. Class dismissed. Ciao for now.